Hello everyone, and welcome to another episode of the Daily Gwei Refuel, where I recap the latest news in the Ethereum ecosystem. I'm your host, Anthony Sassano, and today's the 22nd of January 2021. Alright everyone, let's dive into the news from today. So Rocket Pool put out this explainer thread today, explainer blog post really, diving into an overview of Rocket Pool and kind of, how it all works. For those who don't know, Rocket Pool is a trustless staking service, so basically a decentralized staking service for ETH2. It's doing a lot more than that, but that's like the gist of it, the overview of it. And it's been in the works for quite a while now. Bit of history here. This project I think actually started all the way back in 2017, and for those who weren't around back then, there was actually an expectation that ETH2 was going live in like 2017 or 2018. No one knew that it would take as long as it did. Obviously, it took much longer than that, right? A lot of things changed, and pretty much like a lot of the rollout changed. There wasn't going to be a phase 0, right, beacon chain, separate chain, or anything like that. At the time, it was going to be basically an upgrade to ETH1, but obviously things changed a lot since then. But obviously that changed Rocket Pool's plans. They kind of like, I think, kind of got screwed around a little bit there. But, they've stuck to it, they've kept building, and I think they're very, very close now to an implementation that's going to go live, and then people can use to do decentralized staking. And not only, I guess I should say, like, why would you want to do this? You can just stake on your own, right? Why would you want to use Rocket Pool? Well, Rocket Pool's customer base are those that don't have 32 ETH to stake on their own. So as you all know, you need a minimum 32 ETH to spin up your own validator on your own hardware. Now, that's a lot of money. That's over $32,000 right now. Obviously, it was a lot cheaper back in the day, but it's not now. So to get more people in to decentralized staking rather than using exchanges to stake, Rocket Pool's created this network here, and it lets you stake with kind of like little amounts of ETH. So you can stake with 1 ETH or 0.5 ETH or whatever, or 2 ETH or whatever you have. Or whatever you feel comfortable with staking through their service. So if you want to learn more, this is part 1 of a blog series they're doing about the decentralized staking protocol. I think this is just giving an overview so that people can learn how to use it, what it's all about, the tokenomics of the RPL token, how that works, and the launch details and everything like that. So they've got like the launch details down here at the end here, I think. Yeah, so they're in live beta right now, and you can go test it out if you'd like to. I think they're saying here that the beta finishes on 27th of Jan, so maybe we're getting a mainnet relatively soon. I don't know if that the mainnet has been announced yet. The date has been announced yet. I've missed that, but I'm assuming if it had been, it would have been reiterated here. So I'm still expecting this to come out relatively soon. As I said, it's been in the works for a while. They have a lot of things going on. They seem very close to a mainnet launch, so very excited to see this go live. I'm very curious to see how many people will do this decentralized staking with Rocket Pool, because we want the network to be as distributed as possible, right? The ETH2 network. We don't want people staking with exchanges, ideally. That's going to happen anyway, of course, but we would like to encourage people not to do that. So giving them the tools to be able to do this is much better than, just hoping people will stake on their own, or if they're using an exchange to stake, it won't centralize around one exchange. Because really, the only option you have if you don't have 32 ETH is to either use one of the, I guess, staking services on Ethereum that give you a tokenized kind of stake position, like what Lido Finance is doing, or use an exchange, a centralized exchange to do it, right? There's not really a decentralized alternative. That's where Rocket Pool comes in. So I'm very, very excited to see them go live and to see their kind of system in action, and to see kind of how much uptake it has. I assume it's going to be slow at the start, like everything is. But, as we get kind of like more new users coming in, they find out about staking and they're like, oh, I don't really want to do it on exchange. What's the other options? We can send them to Rocket Pool, right? Which I think is very important for the whole ecosystem. So Jacob Franek shared this chart on Twitter today, which I thought was really cool. So this shows the Ethereum and Bitcoin transaction counts. Now, Ethereum is obviously way ahead and has been way ahead for quite a while. I do want to make a note that this is Ethereum transaction counts, counting everything on Ethereum, all the tokens, right? Whether that's ERC20 tokens or NFTs, basically any asset. Like a lot of this would be stablecoin transactions, obviously ETH transactions as well, but predominantly it's not ETH, because he shared another chart down here. I think somewhere I saw it where he, oh man, if I can find it quickly. Because he definitely did share that it wasn't just ETH. Sorry, if you just look at the ETH transactions that are being shared, here it is. I don't know why it was hidden there, but basically you can see here that just the pure native transactions, so pure BTC being moved on the Bitcoin network, pure ETH being moved on the Ethereum network, if ETH is still lower than BTC here, which makes sense. I think because, more people are, on Bitcoin, you only have the option of moving BTC, right? That's the whole thing of the network. You can't move tokens. There's nothing else really to do on the network. So whereas with Ethereum, you can move ETH, you can move, stable coins, you can move other ERC20s, you can move NFTs, whatever you want to move around. So that's why Ethereum's a lot higher there. So this metric's cool, but it doesn't really paint a picture of kind of like, anything substantial, I would think. I actually think it's quite bullish that ETH is moving less than kind of Bitcoin on its own network. Because when you think about it, you don't want the kind of reserve asset of the network or the store of value asset of the network to be moving around too much. Because, for something to kind of go up in value over the long term, you want people to be holding it, not spending it. Because it's this theory of the the velocity of money. So the more money moves around, right? And ETH is money, of course, and so is BTC. But the more it moves around, right, and the more it changes hands, that means people aren't really interested in holding it. They want to get rid of it, right? They want to discard it. They want to dispose of it. Which is, if we saw really, really high transaction counts for both ETH and BTC on their networks, it would be bearish for those tokens, because of the fact that it means that people are wanting to dispose of it, right, rather than hold on to it. And that's not the best metric to see that. There are other metrics out there that show you how long people have held for, kind of like when they held from, basically, and what price they bought in and stuff like that. But I still think it's interesting that Ethereum has obviously been, ahead of Bitcoin on transactions for quite a while now. That is in part due to, it's due to Ethereum being more scalable, but it's obviously also due to a lot of the DeFi activity happening, and especially the stablecoin activity. So good to keep that in mind, that kind of these charts, they're cool, they're fun to look at, but there's a lot of nuance that you need to go into to actually understand what they're showing. And a lot of the time, they're not really showing anything. Between the comparisons between the two networks, because the two networks are actually quite different in how they kind of operate. They're both blockchains, but they do very different things, and they appeal to very different bases of people. So I'll be doing another Daily Gwei data pump next month that'll cover the months of December and January. You can go watch the first one on the channel if you haven't already, and I basically go through all the different on-chain metrics that you can look at to compare like growth and kind of like see how the Ethereum network's going, see how DeFi is going from an on-chain perspective. And I actually have come to believe over the last few months that on-chain analysis is so much better than technical analysis, even from like a trading perspective or from a long-term investor perspective. Because if you know where to look and you know what on-chain kind of metrics to look at and how to spot certain things, you can make some pretty informed investment decisions that can play out really well. I actually remember there was a fund beginning of 2020 that since blew up. But the reason they blew up was because of Black Thursday, obviously the coronavirus related dump that we had. Apparently they were really levered up, and they had a massive leverage position. They got washed out because of that dump. But their investment thesis, and it was actually working, was on-chain analysis only. They looked at all the on-chain indicators, and they were a Bitcoin-based fund. But they looked at all those on-chain indicators, and they saw that now was the time for the market to recover, right? And it was. If we didn't have the coronavirus dump in March, right, or the Black kind of Thursday dump in March, we would have just kept going up. Because if you look at January and February, we were recovering quite quickly. I think ETH got to $300 or something before that dump happened, if my memory serves me correctly, or almost 300. From like 100, 120 or something like that. So we were moving up. It was the early stages of a bull market. So this fund was right. But unfortunately, they didn't account for this black swan, which obviously washed them out. And so that fund went under. No one really hears from them anymore. But if Black Thursday hadn't happened, they would have probably had the best returns out of any fund, simply because they were so confident in their on-chain analysis that they opened up this massive leverage position, right? Where that would have paid off handsomely for them, I think, over the long run. But, you know, unfortunately, no one foresaw that coming, right? That was such a brutal dump if you think about it. We went from $300 ETH to like $80 or $90, I think it was, in like a very, very short period of time. No one knew what was happening. It felt like the world was ending. And now look at us, right? 11 months later, I spoke about this yesterday. ETH's at $1,200, even after dumping over the past couple of days. So yeah, that's why I'm very, very, someone who pays a lot of attention to on-chain analysis, because I think it is extremely important. It works, right? You might think, can't people fake this? Can't people do psyops or whatever? I mean, they can, but they don't, because there's just too many players in the ecosystem. Retail investors aren't doing psyops for on-chain analytics, right? They're not thinking, if I buy this token on Uniswap, will it trigger some on-chain analysis? Well, yes, it will, but no one is thinking that, right? 99% of people are not thinking that. I don't even think that, and I know that it's going to trigger on-chain analysis, right? I just do it because I can get a good trade on Uniswap, right? I can buy a token that I want to on Uniswap. No one cares enough to do these psyops at this point in time. Maybe in the future it happens. Maybe it's already happening in some areas, right? Some whales are doing it. But for the most part, it's something that I don't think is manipulated yet. So I love looking at on-chain metrics for both for investment decisions and also just out of curiosity. I just love it. I call it chain archaeology, right? Digging into the chain, seeing what's happening, seeing the growth. It just makes me like really bullish, even in times when the price isn't doing really well. Seeing that growth, you can front run the next bull market, right? Or front run, tokens, right? There are some tokens that you can actually watch in real time if you look at on-chain analysis, them being accumulated by new buyers. And then you think, okay, well, if the buyers are increasing, if the holder base is increasing, then naturally these tokens probably going to go up. So you can make investment decisions based on that. And I know a lot of people that do this and they make money doing this. So yeah, I mean, I know I've gone off on a little bit of a tangent there, but I think on-chain analysis is something you need to add to your toolkit going forward. So an interesting tweet from Jay today. So they said basically it's just like three words basically, but it got me thinking. So it reads Ethereum, not blockchain, and I'd never seen it put so succinctly before, right? So kind of like simply, because when you think of blockchains, right? I mean, you think of the technology, you don't really think of the platform themselves. Like I think the term blockchain will actually end up getting kind of washed out, kind of like the internet wasn't always referred to as the internet, right? It was referred to as the information superhighway at some point, which was just bizarre and weird and cringy a little bit, but it was. And there were other names for the internet. There were like proprietary names like AOL and things like that for like different networks. But the internet that we know today is just, called the internet. And then some people, I guess the younger generations call it Wi-Fi, for example. Like I was hanging around some young people recently, and I'm talking like teenagers and younger than that. And they don't really say the word internet, they say Wi-Fi. It's like, do you have Wi-Fi? And I was like, okay, well, I mean, I get why they're saying this, but before kind of Wi-Fi and social media and smartphones were prevalent, right, and all these iPads and things like that, people would say just the internet. And I still say the internet, right? I'm probably a boomer at 28, right? If I'm comparing myself to the younger generations, I'm not with it anymore, so to speak. But I think the same thing's going to happen to the word blockchain. I think in 10 years, blockchain is just going to be used by the professionals in the industry. It's not going to be used by everyday people. They're going to literally call it what the winning platform is. And, I believe, obviously, like truly believe that Ethereum is that winning platform. It is the platform that the world is going to come to know its name, right? Just like they know Bitcoin, they're going to know Ethereum, and they're going to know Ethereum as this platform that hosts all their financial apps, right? All these other Web3 apps and things like that they're using. It's like, but then eventually, I even think the term Ethereum will just be used by professionals as well. There'll probably be a new term that people come up with to describe this kind of new network that we've built. But Ethereum, not blockchain, resonates with me because pretty much all the other blockchains aren't really doing much right now besides Bitcoin, right? And Bitcoin has never liked to talk about blockchain, right? There was always they've got battle scars from when people were pushing the narrative blockchain, not Bitcoin, right? So yeah, I mean that's really funny to think back on and kind of and kind of see the kind of similarities there. But that got my brain this tweet got my brain spinning today. Sorry, mumbled my words there. It got my brain spinning today because of this implication of, you know, where are we going to be in 10 years, right? Where's blockchain going to be? The word blockchain, as I said, I don't think it's going to be part of the common lexicon, you know, that people use. What about the word Ethereum? Is that going to be something that gets abstracted away too? You know, it could be. I don't think so, simply because, I mean, I think there's a low chance of that happening because of the fact that there's an asset tied to it, right? Where ETH, you know, Ethereum and ETH are very tightly coupled. When you're like, you know, promoting ETH or investing in ETH, right, you think of Ethereum. When you're talking about DeFi, you think of Ethereum, right? You know, I mean, we already have, like, actually thinking about it now, we already have a term that people use without mentioning Ethereum. That's DeFi, right? But I do think the DeFi term, as good as it is and as popular as it is, may get abstracted away eventually as well. Maybe we'll just call it finance one day. I mean, that is the end goal, right? To just call it finance. Maybe we just come full circle and we just call this finance. No one says Ethereum or DeFi or blockchain. We're just like finance, and no one says Web3. They just say whatever, right? I don't know what they're going to say, but they just, you know, maybe they just say like Twitter, but the decentralized version of Twitter, for example. So yeah, that's why this tweet got my brain spinning, and I just wanted to kind of share those thoughts with you guys. So interesting tweet out from Ryan today. So he's actually shared a screenshot from the Off-Chain Labs Discord. So what Off-Chain Labs is a layer 2 scaling solution. They're building rollups as well. They've been around for quite a while. They're pretty close to mainnet, I think. And they're building optimistic rollups, so something similar to Optimism. But basically this Discord post, what it says is that their chain, their kind of optimistic chain, is going to be what they call a community chain, and it will just use ETH for fees, and there will be no new token. I thought that was really cool because we don't actually know how a lot of these layer 2s are going to monetize, what tokens they're going to take for fees, things like that. I suspect that Optimism will have a token, right? That'll run the validators, that'll be paid for fees, that'll act as like economic incentives for things like MEV, which is miner extractable value, which is quite technical. You can Google it if you want a breakdown of what that is, but I think that's going to happen. I'm not sure, you know, if Starkware is going to do a token, or if Loopring already has a token for their protocol, right? Not necessarily for their layer 2 solution, but, you know, I'm sure that'll become integrated at one point. But yeah, I thought it was really interesting that Off-Chain Labs is just going to use ETH for fees with no new token. I think that makes a lot of sense, right? That's a quick way to bootstrap a community too and get broad support from the Ethereum community. But at the same time, I don't think that people, you know, creating their own tokens, I don't think Optimism creating their own token for their network should be frowned upon or anything. Like, I'm very bullish on tokens in general. I think they're fine when done right. And I assume that, you know, there'll be some sort of like fees being paid to the validators that hold the tokens, right? In some kind of maybe proof of stake system. Maybe there's a block reward or something like that. I'm sure, you know, they're working on it. I wouldn't be surprised at all for Optimism to do a token, and not just them, pretty much a lot of the layer 2s to do a token. They don't need to, as shown by Off-Chain Labs here. They can just use ETH. But it depends on the construction. It depends on what you're trying to incentivize. It depends on the behavior you're trying to optimize for. There's a lot that goes into it. So I'm curious to see which ones do and don't tokenize this year, because pretty much all the layer 2s are going to be out this year, you know, in one form or another. So, you know, I'm curious to see how that plays out there. And as I said, I wouldn't blame any teams for issuing a token here, as long as it makes sense, which I think it does in some cases. So dYdX put out their 2020 in review post today. I'll link it in the description for you to read the whole thing. But basically, they had a pretty big 2020. They increased their trade volume by 40 times in terms of money going through the system. They had thousands of new traders. They launched their perpetual contracts. You can see the charts here of them, kind of the cumulative trading volume going up to, you know, I guess the start of 2020 it was quite slow, but then it rapidly kind of accelerated, and they've accelerated even more recently at $2.5 billion here. They've got a bunch of other metrics and charts here that I won't go through right now, but it's really cool to see, you know, how fast they've grown. They've grown with the rest of DeFi as well, which is great to see. And they also talk about how they're going to be scaling with Starkware. So going to layer 2 with ZK rollups here, which is going to be big for them. I think their protocol is already incredibly popular, as seen by the growth there, at least in the context of DeFi. Can you imagine what it unlocks on layer 2 when we have scalability? Because I think scalability is holding them back. I know it is. It's not even an opinion. I think scalability is holding dYdX back from being able to achieve their kind of full vision here of a fully decentralized exchange that focuses on like perpetual products. And once they have that, I think they're going to unlock so much more liquidity. I could see them doing hundreds of billions of dollars worth of trading volume maybe this year into next year. Same with all the other exchanges like Uniswap and stuff like that. It just, when you have that scalability there, there's no limits anymore. Everyone can trade on it, right? The fees are really low. It's really quick. The arbitrage between layer 1 and layer 2 is going to be quite wild for a while, I think, until that becomes more efficient. So we're going to see a lot of that happen in 2021 and into 2022. So I'm very excited for that. So quick update from Yearn Finance today. So they updated their version 2 of their Y vaults with a new fee structure. There's no more withdrawal fees. So they were criticized for this because the withdrawal fee was 0.5%. So if you put your money in and didn't stay in for a little while, didn't even make the yield back, you would get, taxed with this fee more than you made. So now they've done a 20% fee on revenue and a 2% management fee. So it's basically a fee on the performance or the yield generated by the protocol. So if you make, 10, just as a simple example, if you make $10 of yield, they'll take 20% of that, which is $2, and then a 2% management fee, which would be 20 cents. So that's a normal 2-on-20 structure, right? That you see in a lot of traditional finance. I think this is fine. I don't mind paying a fee if I can put my kind of yield on autopilot. And this fee is, of course, going to the treasury, where it can be used by Wi-Fi holders, and the kind of the core team and things like that. But, obviously protocols need to monetize. I do wonder how defensible this is though, because when you think about it, these things are fully open source, right? And because they're fully open source, these strategies can be copied. So if someone just forks this strategy and drops the fee down, then, people are just going to go into that other strategy. So I think that there's a lot of different moats you can have within DeFi outside of that because of everything being open source. Integrations is a big one. And the Yearn ecosystem is obviously quite vast right now with all their partnerships and things like that. So, that might be something that's defensible for them. The Yearn brand is definitely very defensible there. The fact that maybe the strategies have to be manually kind of managed to an extent, right? And then because of that, they basically can't really be copied. Or if they're copied, the people that copied the code would have to manage it the same way Yearn does. And all this kind of, nuance to it that you don't just get when you say, oh, the strategy in the vault could just be copied, right? I mean, it can, but yeah, as I said, there's a lot of different things there to consider and to consider different moats and where Yearn shines, basically. So Redphone Crypto put out this thread today about BTC coming to DeFi. I mean, it already came to DeFi, but apparently he's saying it's going to go full beast mode within DeFi in 2021, thanks to bridges like Ren, Boring DAO, and Thorchain, and also projects like Badger DAO. For those who don't know, Badger DAO is a project that's focused on bringing BTC to DeFi, and they actually have hundreds of millions locked up in their protocol, predominantly Bitcoin liquidity. And this is because as they're kind of advertising, they're tapping into that BTC community, which, Badger is like honey badger don't care, right? It's like a meme from the Bitcoin community. So they're obviously appealing to this kind of space here, right? The Bitcoiner space that may not be interested in holding ETH and doing things with ETH, right? Because of one reason or another, but they're interested in Bitcoin. So Redphone Crypto basically goes through this and goes through, how BTC is going to come to Ethereum and DeFi. It's only a few short tweets here through these bridges and kind of maps it to Ethereum. I kind of agree with this because I was actually surprised and blown away by how much BTC came over to Ethereum already. And it came over predominantly through wrapped Bitcoin, the centralized version. I can imagine that there's a lot of Bitcoiners that don't like that, right? They don't want to use the centralized version, but they will use a credibly decentralized one. So we'll have to see how that plays out. But I'm expecting to see plenty more BTC come over to Ethereum in the near future. So interesting blog post from CoinList here today. They go through basically how tokens have evolved over time, or coins have evolved over time. I'll link it in the description for you to go read it. Just wanted to give some quick thoughts here. I don't want to dive too deep in. But basically, reading through this, it was kind of amazing to see how different tokens kind of have been over the years, right? We had like the ICO era from, I'd say it was from 2016 to like early 2018 or something like that, predominantly in 2017, of course. And that model was pretty poor, right? It resulted in a lot of capital going to a lot of the wrong projects. Then we had the IEOs kind of evolve from ICOs in 2018, right? Which was quite poor as well. And then I think in 2017 and 2018, we also had airdrops, but different. The airdrops were different to what they are today. The airdrops were given to like everyone. There wasn't a specific criteria for the airdrop. It would just be airdrop to every kind of active Ethereum address. The most famous one being the Omise Go airdrop. And also liquidity for these airdrops was hard because now with Uniswap and decentralized exchanges, anyone can provide liquidity, right? But back then, there wasn't any of those services, so you had to just pray that exchange listed this token when you created a new token. So that's why I think airdrops are more successful today. And then they go into like basically how there's liquidity mining now, right? In 2020, or yield farming, whatever you want to call it. There's all these different novel mechanisms of issuing a token, like the balancer pool sales, and there's the Mesa auctions sales as well. There's like ICOs kind of coming back sort of in some limited way, but not really. And then of course there's as I said, the proper airdrops as well. So I just thought it was interesting to see the evolution. Go give the piece a read if you want to dive deeper there. So this isn't Ethereum related, but I thought it was very important. So over the last couple days, there was reports of a double spend on the Bitcoin network. Now, if that actually happened, well, first of all, it didn't happen, right? There was no double spend on the Bitcoin network. But if it actually happened, it would be extremely bad. Probably one of the worst things to happen to Bitcoin in its history. And the reason is because a double spend basically means that someone was able to spend the same Bitcoin twice on the network, essentially inflating the supply. Now, that, as I said, would be the worst thing to happen in Bitcoin's history. So you want to make very, very sure that was actually the case before you publicize this. And the reason why it went so far was because BitMEX actually said this, their research desk. And their research desk is actually quite good normally. So people trusted it, right? It came from a credible source. But they should never have tweeted that, because it was literally normal behavior for the Bitcoin network. And I'll link this thread in the YouTube description. But the TLDR is basically that, you know, the Bitcoin network has works with proof of work mining, right? And if you just wait for one block of a transaction to be confirmed just with one block, that block could later be orphaned in the next block, right? And become an orphan in Bitcoin. It's called an uncle block in Ethereum. And then that could be basically, that block could be kind of, as I said, orphaned, which means it's not part of the main chain. And then that original transaction that you thought was a double spend isn't, because that block is not part of the main chain, right? I know I'm bastardizing it a bit here because it is a little bit technical if you don't have context here. But go read this thread for the full kind of thing there. But I did want to kind of bring it up just because it actually led to a lot of FUD. And I don't know if it led to the sell-off. I think that's a bit of a stretch. But it did lead to a lot of FUD, and it plays into Ethereum as well, because Ethereum runs on proof of work right now too. And this, you know, double spend could technically happen in Ethereum too. But as I said, for Bitcoin, it was be the worst thing that could happen. Ethereum, pretty much the worst thing that could happen as well. So you really, whenever you see this news, you want to make 100% sure that it is right, and even if it's coming from a credible source, you want to obviously check different sources, because this kind of stuff is just so bad if it was to actually happen that it would be, I don't know if it would be the death of Bitcoin or like crypto in general, but it would be so bad that it would require people to reevaluate things, right? It would mean that someone was able to get majority control of the Bitcoin network, essentially, or there was some bug in Bitcoin in the Bitcoin protocol that allowed this. a bug allowing this would be better. Someone getting control of the Bitcoin network would be a disaster scenario, I think, a nightmare scenario. So this is why when I saw this, I was like, no, surely not. Because I first saw the BitMEX tweet. I was like, no, this isn't right. There's no way there's a double spend on Bitcoin because this would be catastrophic. And then I went and sought out these other sources, and many in the Bitcoin community put out tweets, and put out, and Andreas Antonopoulos put out a video as well, so you can go watch that on his YouTube channel. But basically, I had to check it because I was in disbelief about it. I was like, "There's no way this is true," and sure enough, it wasn't. But if you're newer to the ecosystem and you don't actually know how bad a double spend is, or can be if it was actually to occur, then it's easy to kind of like fall for this, right? And not fall for it in the way that you get tricked or whatever, but believe it, especially if it's coming from a credible source like BitMEX, or BitMEX's research desk. So I'm actually very disappointed in them for doing this because it probably did play some part in the market action, but on top of that, it required like so much people to kind of come together to debunk this, because kind of bad news or drama or bullshit spreads much faster than kind of like the truth, right? So it's very hard to kind of like correct this misinformation, and it required an ecosystem-wide effort to do it. So that's why I'm bringing it up as well, just for anyone that didn't see these explanations here. So yeah, nothing to worry about with Bitcoin, because that would be bad for Ethereum as well. You know, if Bitcoin had a double spend and the market was like, holy shit, I need to sell my BTC and get out of this stuff, ETH's dumping along with it. Like, I'll be honest, there's no way that ETH would survive that. In the short term. Long term, we'll see what happens. But short term, the whole market would sell off and everything would crash. I think. Maybe that's hyperbole. But honestly, I mean, I would personally be considering kind of like my position at that point. It'd be like, okay, this is really bad. What's happening? But as I said, there's two different ways. If it's a bug, I'd be like, okay, if it's just a bug, they can fix it. Even though they don't want to fix it because they don't like hard forks, the Bitcoin community, they would fix that because it's catastrophic. But if it was actually a 51% attack where the majority of the network was overtaken by one party, that would be, catastrophic. So good to keep in mind, but I'll digress for now. I don't want to, I think I've gone over time here, over 30 minutes already. All right, I'll stop there. So that's it for today, everyone. So if you haven't subscribed to the YouTube channel, do so. Give the video a thumbs up. Subscribe to the Daily Gwei newsletter. Join the Discord. And since it's Friday, I'll catch you all next week. Thanks, everyone.